content related to payroll tax features and benefits for your business through the Families First Coronavirus Response Act and the CARES Act. Just want to make sure you all can see my screen. Okay. Before we get started, know that you will be on mute throughout the webinar. You can ask questions in the control panel using the questions tab. We are going to save time at the end for Q&A with our presenters. On the screen, you can see where to expand and collapse your control panel and where to type in your questions for our panelists. We will give contact information at the end of the presentation, and know that we are going to send a recording of this webinar as well as include the slides within probably today. So don't worry too much about taking vigorous notes. If you are not familiar with Work, we provide payroll and workforce management technology, as well as HR services to the cannabis industry. We serve operators in every vertical across the US by offering tools for hiring, onboarding, time and attendance, scheduling, workforce analytics, cannabis-friendly payroll, and tax remittance. Speaking of tax, let's go ahead and review what we'll be covering today. We're going to briefly explain what the CARES and FFCRA acts are. We'll talk about the tax aid summaries, and then we'll go into detail about Social Security payment deferrals and credits, as well as tax exemptions and Emergency Paid Sick Leave Act. And then, as I mentioned, we will save time at the end for questions and answers. Today, I am happy to introduce a member of Work's leadership team, as well as a few of our trusted partners in the space. Martin Howell is the Senior Vice President of Operations at Work. He has over 20 years experience in human capital management and a proven track record of creative problem solving in payroll and tax. Martin oversees compliance, banking, tax, and billing operations with an emphasis on accurate data management and outstanding customer experience here at Work. Nick Richards is a partner in the tax practice group at Greenspoon Martyr. He represents individuals and businesses in tax audits and trials, mergers and acquisitions, in managing tax debt, and he advises cannabis companies, owners, and investors regarding tax and regulatory compliance matters. He has been a tax attorney for more than 20 years, beginning his career with the IRS, where he was a leading trial attorney, a chief counsel advisor, and a special assistant U.S. attorney. From Bridgewest, we have Jim Marty. Jim is a pioneer and leader in the cannabis industry and is a nationally recognized and renowned expert on marijuana tax, accounting, and banking issues. Since 2009, Jim's practice has grown to more than 400 cannabis clients, and he has consulted in more than a dozen medical marijuana IRS audits. Calvin Shannon is principal at Bridgewest and has over 17 years of experience providing tax, audit, estate planning, and trust services. He is skilled at understanding clients' challenges and working with them to develop and implement innovative and unique solutions. My name is Heather Smith. I'm the Director of Marketing at Work, and I will be your host today. But for now, I'm going to hand it over to Martin and team to walk through this valuable content. Martin, take it away.
Great, thank you, Heather. I'm very pleased to be on this panel, and thanks everybody for joining us for this call today. I wanted to note that the audience, we have a mixture of current clients at Work and many of you who also have been invited to attend for informational reasons. We're glad to have everyone joining us for this tax call. There are a lot of elements to the CARES and FFCRA Act that we want to cover here, but primarily I'm directing this webinar to the tax law benefits specific to employers under the CARES and the FFCRA Acts. We'll touch lightly on eligibility for some of the other elements, and I'll ask Nick and Jim both to jump in there in just a moment. But primarily, again, we're focusing on how those of you who are employers in this industry can benefit, especially those of you who are Work clients, how Work can help you take advantage of the 5 specific tax benefits that fall under the CARES Act and the FFCRA. Let me give a brief summary, and then I'll turn some time over to Nick to talk about eligibility. As many of us, if not all of us know, we have two amazing acts that have been enacted by the federal government. The first, the CARES Act, which stands for Coronavirus Aid, Relief, and Economic Security Act. The $2 trillion, the famous $2 trillion package, which is aimed at combating the economic damage from the coronavirus crisis. There are incentives here for the retention of employees. There are delays of Social Security tax payments that can be made that both fall under the CARES Act, and I'll get into those details in a moment. The FFCRA, or Families First Coronavirus Response Act, requires certain employers to provide employee paid sick leave or expanded family medical leave for specific reasons. And those provisions do apply from March 13th through December 31st of 2020, approximately 9-month period of time. So Nick, if you want to speak a little bit, if you could, to eligibility under both of these acts. I'm not hearing your audio yet. Are you on audio? You're showing as open mic green, not muted, but Nick, why don't you jump in when your audio is able to work, and we'll move on, and we'll as soon as you speak up when you can, and when you know that your audio is caught up with us. Heather, why don't we jump to the next?
I just got it.
Nick, you got audio. All right, go ahead and roll.
Yeah, sorry about that. I've got a big window in front of your and my faces, so I can't really see us, but I can hear you now. I think for this group, the most pressing question is, are these credits available to the cannabis industry? And, it's an area that there is no specific guidance on yet. And we all have to look to 280E for just a little bit of a check to see if 280E would impact these credits. Section 280E does say that it applies to all deductions and credits. So there is a chance that the IRS could take a position that 280E impacts the credits in one way or another. We don't know that yet. We haven't seen that yet. And the folks on this panel, I think, are all in consensus that we don't think that cannabis companies would be precluded from claiming these credits under Section 280E. Mainly because of a couple things. First off, it's not an income tax item. It is a payroll tax credit. And so it's a little different than the types of expenses that are normally disallowed under Section 280E. And of course, these people, if you had to argue it to a revenue agent or to the United States Tax Court, these credits are available for people who are, for the most part, staying at home and not working. So it's hard to suggest that they are, quote, trafficking in a controlled substance if these employees are staying at home. And then the third thing, if 280E did impact it, you'd have to say that, like other 280E expenses, it would only impact the retail employees and not the production employees, like a cost of goods sold expense is allowed for a production, but not a retail cost. So that said, I think that we are in consensus that we do think that the full amount of the credit is allowable to the cannabis industry. We haven't heard anything otherwise. We have heard, for example, on the PPP small business loans, they have come out with statements saying that the cannabis industry is not entitled to those loans. They haven't done this for these credits. And so far, I think we have to take the position that it is allowable to the industry. The specifics on what an eligible employee is, and I'm just reading from irs.gov here, eligible employers for the purposes of the employee retention credit are those that carry on a trade or business during calendar year 2020, including a tax-exempt organization that either fully or partially suspends operations and experiences a significant decline in gross receipts. And there's some tests about what fully or partially suspends is and what a significant decline in gross receipts are, that they're a little beyond the purposes of this call. But generally, if you're in a state and your governor has issued a stay-at-home order, then you probably qualify.
That sounds great. Thank you, Nick, for that response and that explanation of eligibility. We do want to remind everyone that if you have specific questions that come up, please don't hesitate to go to your panel and type in your question. We already have a couple of comments and questions that have been entered up till now. Jim, was there something else that you wanted to jump in and discuss on that, or can we move forward?
Yes, just very quickly, we've had discussions offline, and we are pretty much in agreement. As we go through the specifics of these acts, we'll point out the provisions that we think are available to the cannabis industry and those that are not.
Okay, that sounds great. We already had one question from Susie Osborne. If it's a payroll tax credit and it impacts your COGS calculation, would you not be able to take the credit? And I think what we're saying here, based on both Nick and Jim's responses, is we believe these credits are going to be available all the way through. Jim, do you concur with that from an accounting perspective?
Yes, and if I'm understanding the question, I would say if you get the credit, then your payroll tax expense that's properly included in cost of goods sold for a cultivator would be reduced by the credit you receive.
Okay, great. All right, let's move on to the next slide, and let's dig right into the 5 tax aids that are provided under these 2 provisions. The first tax aid, and this is these are the summary of all 5, and then we'll have a slide for each one to get into some of the detail. The first 2 are enacted by the CARES Act. The first is a deferral of employers' Social Security payments until 2021 and 2022. And for all of our work clients, this is ready to implement. We have this in place. We just ask that you sign an acknowledgement, reach out to our support team and sign an acknowledgement that you want to take advantage of any or all of these tax aids. And once you get that back to us, then we can programatize it in our work system for you. This deferral, all 5 of these, I might add, have to do with the federal tax deposit and a reduction of that tax deposit. The first, the deferral of employers' Social Security payments until 2021 and 2022, that's one of the pieces of everyone's federal tax deposit that happens per pay period for most clients. The second, the CARES Act, is intended to put money into the pockets of employers so that they'll be incented to retain their employees. We're calling it a retention credit. The amount of that credit will detail on one of our future slides, and that will allow the money gets back into the hands of the employer by the employer reducing the federal tax deposit. That's how the credit is enacted here, and it's only for impacted employers. And there's some rules and regulations around that Jim will walk through when we get to that slide. Tax Aid 3. Is now under the FFCRA. All 3, 4, and 5 have to do with the leave provisions of the FFCRA. And number 3 is an employer Social Security exemption for those new leave types. In short, if you're paying out a couple $1,000s in leave to an employee on a particular pay period, that $2,000 or hypothetically whatever the amount is will be exempt from the employer Social Security tax, the 6.2% that we all pay for wages for each of our employees. That's a very unusual exemption, and again, that has a net result of reducing not just our federal tax deposit, but our federal tax liability. Tax Aid 4 is regarding the emergency leave also, and this is a full tax credit for the actual wages that are being paid out under the 3 wage type provisions of the FFCRA. And that allows employers to reduce their tax deposit by the amount of those wages that are paid out. This is how the IRS and the federal government is keeping the money in the hands of the employers to cover those sick wage types that we are setting up in our system. And Tax Aid 5 is very similar to Tax Aid 4. It's also a reduction of the federal tax deposit that goes out each period. And this one is accounted for by the employer Medicare and health insurance costs. So whatever the amount of the employer Medicare and health insurance costs for the sick wages that are paid out, is rolled up into a credit, and again, a dollar for dollar reduction of our federal tax deposit each period. And as you notice on the subheadings under each of these 5 acts, 3 out of the 5, we still have programming in place. We're being told by our support team and our IT partners that the programming will be in place very shortly. So items 1 and 3 are ready to implement and ready to roll, and items 2, 4, and 5 are coming soon. All right, let's go to the next slide. All right, this is the first of the deferrals. This is a deferral of Social Security payments on all wages. The eligibility on this, it's not available to an employer who has an SBA loan under the Paycheck Protection Program established by the CARES Act, and the loan has been forgiven. So that's a kind of a narrow audience. So pretty much anybody is receiving this. But if you're one of the employers that does find yourselves eligible for the SBA loan and you get that loan forgiven, then you would be exempted from this particular benefit. This is for taxes that are incurred between 3/27 and 12/31/20. And again, it's just the employer portion of Social Security tax, just the 6.2% that the employer matches on what's withheld from employees. This does not change what is withheld from employees. That will stay constant through the system. Now, please go ahead, Jim, jump in.
So Martin mentioned the Paycheck Protection Program, the PPP. The panelists here all agree that the PPP is not going to be available to the cannabis industry. So the direction we're going to take as this webinar continues is to look very carefully at this Social Security deferral arrangement that at this point in time we feel it is. So we won't be spending a lot of time on the PPP or the economic disaster loans. The SBA has been very clear in recent days, and I'll let Nick chime in, that they don't intend to approve these for cannabis companies.
Okay, great. Thank you, Jim. And so this tax will not be pulled from employers as far as those of you who are our work clients. We will not pull the 6.2%. It will remain in your bank account. We will help you continue to account for the accumulation of that from March all the way through December. And then we will publish, as your payroll provider, we will provide a report that tells you what you will need to pay before the new extended deadline, 12/31/21. Keep in mind, that's 20 months away. So we're all going to want to be super careful to make sure this stays on our radar. Then that 50% of that deferred employer Social Security tax will need to be paid by 2021 December. And then the remaining 50% will be paid out by 12/31/22. Yes. We will, again, we will help provide that information to our clients. Jim, any other comments that you'd like to make on this before we move to the next?
Hand it off to my partner, Calvin, to talk about potential personal liability if you do take part in this program. But before I do, I want to point out that with a 3/27/20 start date, this is not going to affect the first quarter of 2020's payroll tax returns very much. And Martin, I think you got some guidance recently that this will really kick in for the second quarter of 2020.
Yes, it will.
Yeah.
And we will not, go ahead, Calvin.
Go ahead, Calvin.
Yeah, sorry to interrupt you. Yeah, that's the one important thing that I want to mention regarding the payroll tax deferral. Well, this is a great deal, but for the most part, when I discuss it with my clients, I just want make them aware that this does come with the normal hazards for remitting payroll taxes, and to the extent that will eventually have to be paid back. It's generally the company's responsibility, but the person that's responsible for directing these payments can become personally liable. So that's just a warning that I'm giving to every client that I discuss this with. And I don't know, Martin or Nick, if you'd have any additional comments on that, but I just think it's important and noteworthy. Thanks for bringing that up, Jim.
Yeah, no additional comments. Thank you for that. Thank you for that. Go ahead.
I would just say that, Workgroup provides a really good service for its clients in maintaining records on their behalf. If the question about ability, the records that you have.
Nick, I think we're losing your audio. All right, Jim, do we still have your audio?
Yes, I'm here, and I'll fill in for Nick while we wait for his buffering to catch up. But yes, as Calvin was pointing out, where there is the potential for personal liability that could trickle down to a non-owner, say a controller, the record keeping is very important. I think that's what Nick's point is, and we do want to compliment work on the great job you do on your record keeping on behalf of your clients.
Okay, that sounds great. Why don't we move on? I will jump into one question that relates to this, and it will relate to all of them, from Tim McMurray. Thank you, Timothy McMurray. Thank you for your question, which reads, the law states that if the FFCRA payroll credit is higher than the liability, the government will issue a refund by check. Is that the case for cannabis companies? Would it be better to drag it out so deduction does not exceed liability? I'll answer the first portion, and then Jim, maybe you could jump in on the second. We do believe that that is the case for cannabis companies. A form can be completed if the liability exceeds the amount of the federal deposits and the employer still wishes to receive, that difference back. And would it be better, Jim, in your estimation, to drag it out so deduction does not exceed liability, or is it just as well to request the refunds as you go along?
Well, this is a very fast-moving ball, and we're all still trying to get our heads around it. As a general rule, I would play it straight and not intentionally drag things out. Calvin, do you have a comment?
No, nothing really additional. I guess pretty much I'd agree. Kind of answering the second one, I agree with Martin that it would seem like you would want to get as much cash as soon as possible. So I wouldn't see a reason to drag it out. Now, I guess we'd have to qualify that with we don't know exactly what the response is going to be from the IRS regarding all this. But for right now, yeah, I don't see any reason to drag it out.
Okay, great. Why don't we move on to the second one? So this is the second of the tax aids. In general, I will, let me summarize that this is our employee retention credit, and the intention here is to get money into the hands of employers so that they will be incented to retain their employees. And it involves a credit that is paid against the federal tax liability. So again, it's going to reduce the federal tax liability per period. And the calculations on that are listed in the other details. But Jim, would you like to address this? And then
Yes,
I can pipe in at the end.
And I think I'll ask Calvin again to comment. He's really dug into this particular issue on the credit for maintaining your workforce. Calvin, would you like to address some of the points on the screen?
Yeah, I apologize about that. I actually seem to have a delay on my audio, so I apologize. I missed the first part. Could you repeat the question, Martin? I'm really sorry.
I was just wondering, Calvin, if you might want to address some of the points on the screen as far as this section of the CARES Act goes.
So the points on the screen regarding the SBA loan, I think we pretty much covered that. It's would not cannabis companies generally wouldn't be eligible. Is there anything else specific?
Yeah, could you talk about the 50% provision down in the middle of the screen?
The 50%. Oh, yeah. Let me just read it for a second. Maybe you guys could go on, and I'll come back after I
just get
a chance to read
the
it.
one that says the employer's gross receipts are below 50% of the comparable quarter in 2019. So for eligibility here, you're going to want to look back and compare these quarters in 2020 to the same quarters in 2019. And if your gross receipts have fallen by 50% of that number, that's where this particular provision kicks in. Does that set the table, Calvin?
Yep, that sounds accurate.
Okay. So, and you do it quarter by quarter. And you can see that started in the middle of March and will go through the end of this year. There's a lot of details here, probably beyond the scope of this call, but the maximum credit is $5,000 per employee. Again, we think that these credits, and this is where Nick Richards comes in, are going to be available for the cannabis industry as we sit here today. But stay tuned because these things are changing every day. Nick?
Let me jump in here, but so the credit itself on the bottom of the screen is a maximum of $5,000 per employee during the period. It is 50% of qualified wages unless you're an employer with under 100 employees, and if you are, then it's $10,000 per eligible employee or 100% of the wages. And as with the other credits, this is put back into the employer's pockets by simply reducing the federal tax deposit by the amount of the per employee credit. And it is a credit that is intended to be against the employer's Social Security portion of the federal tax deposit. So it cannot exceed the total employer Social Security liability element of the federal tax deposit. If it does exceed that, then once again, you would go into requesting the additional amount that you're wishing to recover under this credit with the form that you would submit to the IRS, and the IRS would issue a check for the extra if it exceeds the total federal tax deposit employer Social Security portion.
Yes.
So, is there anything else? Yeah, please.
As we go through this, you can see how this has really been carefully designed. And I think Treasury Secretary Steve Mnuchin has done a great job. I think he really does understand small business. But you can see that the whole concept as we've been going through this is to get money either into the employer's checking account or the employee's paycheck as fast as possible. So you're not going to have to wait around for a bureaucracy to issue checks. The employer can take advantage of these each quarter of the remaining part of 2020. Do you agree, Martin?
Yes, I totally agree. And in specific for our work clients, it'll be important for you to work with your financial professionals to calculate what this credit is for your particular business to make sure that you qualify under the qualifications that you see in the middle of the screen, and communicate those amounts so that we can programatize them and make sure that your federal tax deposits are reduced by the like amounts. And so that'll be an important communication piece between us and our clients who are wanting to take advantage of this particular provision.
Nick, do we have
any other comments? Yeah, go ahead.
Go ahead, Nick.
Nick, do we have your audio back? I'm not seeing, I think he's lost us on both sides. So why don't we move to the next slide, Heather? Okay, this is the first provision under the FFCRA. And this is with the presumption that an employer has the need and is mandated to use the 3 new types of leave. We've explained that on a different webinar for our clients, and we'll continue to communicate with our clients and those who want the information about the details of the leave and who and how the leave is to be used. We won't go into the details of that here, since this is more about tax than it is about the HR elements of the leave. But suffice it to say for this discussion that there are 3 different types of leave: a paid sick leave, and a child care leave. And in the materials that all of you will have available to you afterwards, we will be including links to the IRS publications so you can read the eligibility requirements specifically. But in general, this applies to employers with 50 to 500 employees. And if you have an employee that needs any of these leave types and you're paying wages under that leave, then we will program in our system. We already have the programming set up. This is already set up in the work payroll system. And once you use that leave, the system will automatically exempt the wages paid under any of these three leave types from the employer's Social Security tax. So it'll have a net result of keeping that money in your bank accounts and reducing the federal tax deposit liability. This one is fairly straightforward. It simply is just saying that they're going to give employers the benefit of that 6.2% and exempting from the 6.2% that normally would apply to leave payments.
So Martin,
yes, please.
This would be for employers who say are furloughing their employees versus laying them off?
This would be this is not necessarily applying to furlough. This is applying to employers who are keeping the employee, and the employee is going to take advantage of one of the three leave types. So there's an 80 hours of leave that's available. So the employee is not working. They're not furloughed, but they're not working because they've been affected by COVID. Or they have they have a child whose school closed down, and so they are taking time off because they have to be at home with the child whose school closed. Or they're taking care of somebody else in their home that has issues with being sick due to COVID-19. So it's just that, but this is not about furloughing.
And why do you think it starts with 50 employees? Is that because many states have mandatory paid leave at 50 employees or more?
Yes, I think so. And they also don't want this to be a hardship for businesses under 50 employees, forcing the business owner to allow employers to allow employees to go out because it's difficult to maintain essential functions of a business if they're asking employers to grant this type of leave. And so typically you see items like this, not unlike FMLA, which has a similar requirement. It's not employers under a certain threshold are not subject to the FMLA requirement. So this follows a similar guideline in that regard.
Okay. And do we have any questions at this point?
Yeah, we do have some questions, and I think I'll save some of those questions till the end.
Sure.
But some of them do relate to these types of leave. Why don't we jump on to the next slide, Heather? So under those same leave types, the IRS is allowing for the wages paid out under any one of those three leave types to be restored back into an employer's account by reducing federal tax deposits. This is a consistent theme that we've had through all 5 of the tax aids. And so to activate the credit, the employer reduces the federal tax deposit by the direct amount of the wages paid toward the qualifying sick and child care leave under the FFCRA. And so I am being reminded here on the leave types that it does affect employers under 50. They would need to apply for a hardship exemption to be exempted from the requirements. But anyway, so in general, we're presuming that they would apply for that hardship exemption and it would not apply. So this is primarily for employers with 50 to 500 employees. So this is one more way for those wages to be restored quickly back into employer's account, or they don't leave the employer account by reducing the federal tax deposit.
And then another question would be, why the 500? Is that because when you get over 500, there's going to be other provisions for big business?
Not sure. Not sure.
I think
that's a great question.
Didn't CARES set up I think CARES set up a direct lending from the Department of Treasury to businesses over 500.
That's right.
So it comes under a totally different program. There was a lot of criticism about how these big businesses get to deal directly with the Department of Treasury, and all the rest of us have to go through whether that's a bank or the IRS or what. But yeah, I think that's the distinction there.
Gotcha.
All right, great. Thank you. Those are great questions. All right, let's go to the final one. I know we have about 15 or 20 questions that rolled in. I want to leave a lot of time for the questions at the end. This is the last of the 5 tax aid provisions, and it's similar to number 4 in that it is allowable for that employers, again, reduce their federal tax deposit, in this case, by the amount of the employer Medicare that is imposed on the wages paid out for the 3 types of leave. Employer Medicare is a 1.45% tax that's typically paid. Also, it is allowed to reduce the federal tax deposit by the allocable health plan expenses that are paid toward the qualifying sick leave under FFCRA. And we've included links, and we'll include in what we send out after the webinar, to the IRS news release and the IRS summary, which is an FAQ. There's a lot of detail there on how to calculate the allocable health plan expenses that we won't go into here. But in general, the idea is that whatever is incurred by the employer to continue the employer side of the healthcare coverage for employees taking advantage of the leave needs to be part of the credit that the employers receive, so that so they recoup those costs by reducing federal tax deposits. So in general, every one of these 5 tax aids allows for one kind of reduction or another of the federal tax deposit, and that's how the IRS is keeping the money in the hands of the employers and in the bank accounts of the employers, so they can take advantage of each of these provisions. Jim and Nick, is there anything more that you want to add to these before we open up for some additional questions?
No, I don't have anything. Calvin?
Nope. Just look forward to the questions.
All good here, Martin.
Okay, that sounds great. Why don't we go to the next slide for Q&A? And I'll kind of go in sequence through and some of these questions. So Liz Radcliffe asks a question again on COGS. Jim, this might be one for you. It says, for growers, payroll is under COGS, so that will not qualify? Or do you think that will qualify under COGS still?
Oh yeah, I mean, it doesn't change the nature of a cultivation employee's W-2. That's still part of cost of goods sold. Calvin?
Yeah, no, absolutely. There's nothing about this that's going to change any way that costs are absorbed into inventory, and not going to change any the nature of any inventoriable cost. I guess the one comment that Jim made earlier that I'll repeat is the only change will be to the extent you have less payroll taxes, that would be an inventoriable cost. To the extent you get some of this, you don't have to send it in, then yes, that it'll reduce your inventoriable cost for that amount. Otherwise, no change to your inventory absorption at all.
I agree.
Let me say this, is that, so that means that basically it doesn't matter if it's a COGS expense or a non-COGS expense for payroll, but you can't both get the credit and take the deduction, right? You can't do both of those.
Right, the credit reduces your deduction.
Yeah, okay.
It reduces the amount that you would absorb into inventory, yes.
Right.
Okay, great. Next question is from Tim McMurray. The law state, no, let's see, we covered that one already. This is from Trip Murray. At some point, he said he might have missed this, but this is a reimbursement that we have to apply for on the back end, or can you hold back the federal taxes from the payroll checks of employees on leave? And so,
yeah, I think this was in reference to the deferral of the Social Security payment.
I think it is in the deferral of the Social Security payment. So Trip, I hope I can answer this. So the deferral of the payment still can be deferred all the way till the end of the 2021. 50% of it is paid at the end of 2021, and 50% is paid. The other 50% is paid at the end of 2022. And so employees on leave, if they are employees and you are posting their wages while they're on leave, if you are posting the wages paid under the sick leave and you are issuing those checks, you are incurring the Social Security liability, and you are able to still include that in your deferral of Social Security all the way into 2021 and 2022. As long as that payroll is running through the payroll system, the mechanics will still work the same way. Hopefully that answers your question. Jim, as long as that's incurred, then it can be deferred, right?
I would agree with the caveat that there's obviously going to be some overlay of these various provisions, and it'll be interesting to see how the calculations come out. But I think you did a good job answering the question as we understand it today.
Okay, great. Next question is from Susie Osborne. Does the liability for the payments follow the person should they leave the company? And so if you still, yeah, go ahead.
I was just going to say this was in reference to what Nick had mentioned and Jim around if a person could be held liable, not necessarily the company. If they are no longer with the company, does the liability still follow that person?
I would leave that one for Nick.
You know, it could still follow the person. It's unusual for that to happen. Usually they look to the current owners and officers of a company for liability. But it could technically, if you were a sort of a person who had the ability to make decisions around this at the time, it could impact and follow you for that time period. But usually that doesn't happen. Usually they look to people with current ability to direct the funds of the company.
Right. And my experience has been on unpaid payroll taxes is one of the first questions the IRS asks is who were the check signers at the time. So it very well could follow a person post-employment.
That's right. And there's two factors for liability, and that is you have the ability to sign a check, so you have the ability to direct funds, and then you failed to pay the IRS. And usually that is proven by showing that you had knowledge of the liability and you paid somebody else first, including your current employees. And so in the general sense, if we're talking about withholding and the trust fund recovery penalty, if you're a new owner of a new business and there's a pre-existing tax liability and you know about it and you fail to pay it and you pay somebody else first, now you also are personally liable potentially for the trust fund recovery penalty.
Yes, as a general rule, always pay those payroll taxes. They're much harder to get rid of, actually impossible to get rid of, even in bankruptcy, unlike federal income taxes. Nick?
Correct, yeah. They're non-dischargeable in bankruptcy, and the IRS still has to honor the employee's portion. When the employee files its tax return, the IRS has to honor that withholding whether or not the employer paid it over. And so the IRS sort of considers that stealing from them, basically, and they take those employment tax violations very, very, very seriously.
Martin?
Yes, great. Thank you. I love your response. Another question from Tim McMurray. Is asking, I think he's asking about the look back period. Does that mean calendar quarter or rolling 90-day periods? The provision of the law looks to say calendar quarter, so you look at it each calendar quarter. This is a tough question from Rich Eckhouse. What about entities that are startups during 2020? So there's no look back period to see year over year the impact of COVID-19. There were two provisions, I think, on that. One was direct closure due to government intervention, and the other was a reduction in revenues year over year. Nick or Jim, either one of you want to tackle that, or is that a big fat we don't know, really? We may not know the answer to that.
Calvin, comment?
No, honestly, I probably wouldn't have much input on that either, no.
You know,
yes,
I think if you're in business, then I think that you would qualify if your state has issued a stay-at-home order and you have wages that are impacted by that. I think that's right, but as the other panelists said, it's a little bit of a gray area right now for me too.
Yeah. That sounds great. Trip asked if the presentation is being taped. Yes, it is, and we'll be making that available at the conclusion. Heather, am I missing any questions? I think you wanted me to kind of roll through these. I'm just kind of going through. Let me know if I'm missing something you think I should be touching on.
Sure. There was a couple questions around whether your company, if your company doesn't have a leave policy, or if you maybe have unlimited PTO. And I know we have some kind of HR resources around this, and we actually did a webinar last week on that we can share out as well, to kind of answer more of the policy related questions to leave and PTO.
Yes.
There's a few questions
so I see a
coming
question. Go ahead.
I was just going to say there's a few questions coming in directly how work is going to be supporting tax deferrals and workforce changes. And we're going to continue to share resources as they're available. We mentioned at the beginning how we're supporting our customers, and we'll continue to send updates as changes are made in our system to our current clients. If there's anything you want to add to that, Martin.
Yeah, well, we will continue to update, and I think as our clients sign the acknowledgement form that we are sending out, we will communicate direct timings and give you educational pieces that show the impact of each and how each one of the 5 tax aids is being implemented and the action that will be required on the part of our clients. In some cases, calculating what the employee retention credit looks like. That's some work that will need to be done on the part of our clients. And the part of the Social Security item number 1 is Social Security exemption. We will do that automatically, and it'll be applied across all of the employees that it applies to. And so there will be no real action required on the part of the client, and we would communicate with the client about when that takes effect. And they would know exactly how it affects and how it shows up on the reports coming out.
Okay,
and
thanks,
so
Martin.
I think that was, yeah, you bet. Are there any other questions, Heather, that you see that we should talk through?
One is maybe relevant. Some of these get a little specific. We may follow up with you afterwards, but we noticed that the date changed for the FFCRA from an effective date of April 1st to now March 13th. Does that affect employers that have already paid employees from April 1st? Is this now retroactive? Do we have any information on that date change that we could provide insights on?
Yes, we will be handling that within our payroll system, and we haven't determined what the IRS wants us to do for retroactive, since they said that they don't necessarily want it reported on the first quarter tax documents, namely the 941. We are looking for a little additional guidance from the IRS about how they want that to be reported and rolled into the second quarter reporting of liabilities. There will be an answer to putting that retroactive. We don't know what that looks like yet, but the answer is yes, we should be able to make it retroactive for our clients that want it to be retroactive.
Martin, have you, there was a long part there where I wasn't able to hear what was going on. Did you mention the Form 7200?
No, I didn't, but that's great. You want to talk about that, Nick, and how clients, if they don't have enough federal tax liability to cover all of these credits and exemptions, what exactly will they do?
Yeah, so first off, I wonder if that form can be used to recoup some of the amounts paid in for first quarter. Because what the form allows, and I'll just give an example, let's say you're entitled to a credit of say $10,000, but you only have employment taxes of $5,000. Well, the Form 7200 you use to actually request that net difference of $5,000 in my example, and the IRS will actually send you a check for the difference. Now, there's a cautionary statement there. If you get a check for $10,000 and then you take part of that $5,000 as a credit, you've just quote double dipped, and you shouldn't do that. You either get the cash or you get the credit, but not both. but the Form 7200 would be used to request an actual check for the net difference between your payroll tax liability and what your credit amount is.
Yeah.
And that's a brand new
that's
form, I should add too.
And then I
Yeah,
have
that's a great point.
couple of closing comments from me. Is we talked about cannabis companies. We think the Paycheck Protection Program and other SBA economic disaster loans do qualify for CBD and hemp companies. And so we are actually applying for PPP loans and grants for CBD companies. Nick, do you agree?
Yeah, I do, and I actually had a bank reach out to me. If anyone wants a bank contact, I did have a bank reach out to me here in Colorado and asked that I make them available to people, non-marijuana cannabis companies that are looking to get the PPP loan.
And then another final comment from me, a little bit outside the scope of this webinar, is what about your 1099 employees? What about guaranteed payments to partners? We don't have clear answers yet on that. We're working through those issues with the banks providing the loans. But it's almost a case of better to shoot a little too high and include your 1099s, see if the bank will submit your loan application with your 1099 contractors, with your guaranteed payments. But we expect to have an answer on that before this week is over, because we've reached out to a couple of banks on that already.
Jim, I think I've seen some things saying that 1099 employees and self-employed individuals qualify for the PPP.
Yes, we have mixed answers on that at this point in time, but we're taking the position as you just stated it. And one last thing on 1099s. So many people overlook 1099s. You know, at Bridge West, our philosophy is better late than never. So even though your 1099s for 2019 were due back in January and February, go ahead and do them now. If you paid your lawyer, your accountant, self-employed people, your landlord, get those 1099s done. They're very, very valuable when you get audited. In fact, it'll be one of the first questions the IRS will ask if your company is audited.
Great, thanks, Jim. Yeah, it's not a matter of if, but when you're audited, right? I would love to take a little bit of time to thank all of you for your expertise on this matter. We've got the contact information for each of our presenters on the screen now if you have additional questions. And again, a recording of this webinar as well as the slides will be available by end of day. So thank you again to our presenters, and thank you so much to the attendees for taking time out of your day. We have additional resources on our website for employers that are in need of more guidelines around coronavirus, including some of those HR topics that I had mentioned. I know Jim and the Bridge West team also have some blogs and content related to this, so please use those resources available to you. And hang in there, everyone. Enjoy the rest of your Wednesday.
Thank you.
Thanks, Heather.
Thank you.
Thank you, everyone.